You know, every single day, we're just bombarded with information, right? Alarming headlines, super complex data, expert opinions that all seem to be saying different things. It's just a constant stream of noise. So in this explainer, we're going to pull back the curtain and look at how the world's leading analysts actually do their job. How do they cut through all that noise to find what really matters, the signal? So you're scrolling, and 1 minute, you're reading about some potential crisis in crypto that could, threaten the entire network. And then the very next second, you're trying to wrap your head around this huge geopolitical chessboard and how a trade war might completely upend global markets. And then, to top it all off, you get a warning from a massive institution like the World Bank, basically saying the whole global economy is fragile. It's a lot, isn't it? Each one of these headlines is an entire world of complexity by itself. So it just begs this crucial question. In this absolute storm of data and headlines and warnings, how does anyone make any sense of it all? How do you possibly get from that kind of chaos to an actual usable insight? Well, it all comes down to a process, a kind of pipeline for in-depth analysis. And that whole process, it always starts in the same place, the foundation. It's all about gathering the raw materials you need for analysis, and that material is data. Look, before anybody can make some grand theory or a big, bold prediction, you need the basic building blocks. And we are not talking about just a handful of numbers here. We're talking about collecting information on a truly massive scale from pretty much every corner of the global economy and the digital world. To give you some perspective, just think about the scale of one single traditional data set. The World Bank's International Comparison Program, which helps us understand the global economy, is built on collecting more than 7 million individual prices from almost 200 different economies. That's just a mind-boggling amount of work for just one data set. But then you pivot to the digital world, and those numbers just explode. A crypto analytics firm like Santiment, for example, tracks over 75 million labeled Ethereum addresses. That's more than 10 times the data points from that huge World Bank project, and it's for just one tiny slice of the crypto world. The scale is almost hard to comprehend. And this data gets pulled from an incredibly wide range of sources. You have analysts looking at economic reports from the Fed, while at the same time digging into on-chain crypto data from firms like Glassnode. They're combining market data from Bloomberg with policy research from think tanks. The whole point is to create this multi-layered view, because the real signal, it's hardly ever found in just one place. It usually pops up at the intersection of all of them. Okay, so having mountains of raw data is one thing. That's a great start. But let's be honest, piles of numbers by themselves are pretty useless. You need the right tools and the right frameworks to interpret them. This is where we go from just collecting info to actively hunting for the signal. So, in the world of crypto, one of the most powerful tools out there is on-chain analytics. What in the world does that mean? Well, it's basically the study of a blockchain's public ledger. Think about it. Every transaction, every transfer, every single action is recorded. By analyzing all that data, you get this incredible real-time peek into investor behavior and the health of the entire network. And this is what that data can actually show you. For instance, are huge amounts of Bitcoin suddenly moving onto exchanges? That could be a sign of selling pressure. Are the biggest wallets, the so-called whales, quietly buying up more? That's a classic sign of accumulation. You can even see if the average person holding the coin is in profit or at a loss, which can help predict what they might do next. It's almost like having a direct window into the market's brain. Now, let's switch gears and compare that with a really important tool from global economics: purchasing power parities, or PPPs. The World Bank uses this to answer what sounds like a simple question: how much did stuff cost in different countries? By comparing the price of a regular basket of goods, PPPs let economists see past exchange rates and compare economies and living standards on a much more level playing field. It's a different tool for a different problem, but the goal is exactly the same: find a clearer, more accurate signal. Okay, this is where it all pays off. We've gathered the data, we've used our tools to find the signal. So what? Well, the final step in the whole pipeline is turning that signal into action. This is where all that in-depth analysis finally meets the real world. It really doesn't get much clearer than this. This quote is straight from the Federal Reserve's own policy statement. They are, in their own words, explicitly data dependent. Their huge decisions aren't based on guesswork or a gut feeling. They are a direct response to their analysis of all the information they're getting about the economy. So what kind of incoming information are they talking about? Here is a perfect example. A key indicator like the US inflation rate is always on their dashboard. I mean, they are watching its every move. Is it going up? Is it falling? Is it where they expected it to be? This one data point is an absolutely crucial signal for them. And here's the payoff. The analysis of that inflation data, along with a ton of other indicators, leads directly to one of the most powerful economic decisions in the entire world, whether to raise, lower, or just hold interest rates. And that decision then ripples out and affects, well, everyone. Data literally becomes policy. And this same exact principle applies in totally different fields too. A smart crypto investor follows a really similar process. They aren't just throwing darts at a board. They're analyzing those on-chain metrics we talked about. They're looking at what the biggest players are doing, and then they make a data-driven decision. The tools are different, sure, but the logic from data to analysis to action, it's universal. Okay, so we've seen how this process works for central bankers and for crypto whales. But why does any of this high-level analysis matter to the rest of us? The answer is it actually matters a whole lot. I mean, just think about it. When the Federal Reserve analyzes all that data and decides to change interest rates, that directly affects the rate you pay on your mortgage or your car loan. When the World Bank uses PPPs to research poverty, that research shapes global policies that can change millions of lives. And when market analysts spot those on-chain trends, that can highlight real risks and opportunities for your own personal investments. This stuff isn't abstract. It has real, tangible consequences for all of us. Ultimately, this is the real power of the whole process. The world just throws an overwhelming amount of information at us every single day. It's chaotic, it's confusing, it's noisy. The art of in-depth analysis is what lets us filter through all that chaos, find the signal that actually means something, and turn it into clear, actionable understanding. Which, I guess, leaves us with one last big thought. We have more data and more powerful analytical tools than at any other point in human history. We can see the global economy and digital markets with a kind of clarity our ancestors could never have even dreamed of. But does having a clearer signal automatically lead to making better decisions? Now that's the real question, isn't it?